Today, the ruble strengthened for the third day, as Russia pushed on with its annexation of Crimea, and investors wager the impact of Western sanctions will actually be mild. Now I'm joined by Manik Narain, an emerging market strategist from UBS. Manik, you believe the dollar will strengthen to 36.75 in 1 month's time against its Russian rival. Now, why do you see the dollar climbing this much in 1 month's time?
Yeah, the markets have responded quite positively to the apparent sort of peaking of the crisis in Crimea. I think what's important to highlight from here, though, is that there's still a huge amount of uncertainty around capital flight dynamics in Russia. Investors need to remember that these capital outflows from Russian individuals and Russian corporates have actually predated the Crimea crisis by a very long way. It's very possible also that if these sanctions from the West are going to be intensified due to, for example, Russia actually formally now annexing Crimea, ongoing concerns about military skirmishes in the region, and even about potential secession of parts of eastern Ukraine. This situation is quite fluid, but this uncertainty can very plausibly lead to accelerated capital outflows. So that is something that I think is still a risk for the currency market on a 1 month view. It's also important to highlight that while the ruble has already weakened, our fundamental models indicate that the currency has simply moved from very expensive levels closer towards fair value. So we don't expect the currency to bounce back very strongly on the back of the ruble being in deep value territory. It's also worth considering as well that the central bank and the finance ministry are likely to shortly resume their purchases of $100 million a day on the FX market, which is likely to last somewhere between 2 to 3 months. So all of these factors should act to constrain ruble upside from here, and we actually forecast some modest depreciation, in fact, for the currency.
And Manik, in 3 months' time, you see the dollar rising as much as 37.5 against the ruble. So what will be the major driving factors you'll be watching out for in the mid and long term?
These are mainly on account of Russia's economic fundamentals themselves, rather than a political call. The fact of the matter is, as I've alluded to, is that capital flight is a significant concern in Russia that the authorities haven't been able to arrest at this point. We're still looking at a very stagflationary environment in Russia. You've got peaking terms of trade, investment stagnating. The quality of economic policy is rather low in our view. We've got credit flowing primarily to the consumer sector. Pensions and defense are the key areas that the Russian government is spending on. There's very little spending on development expenditure in our view. There's little spare capacity left in the economy to fall back on. So we may still be in an environment where Russia's current account is still dwarfed by private capital outflows. So we think that that will be a theme that continues to modestly put some pressure on the ruble. The other aspect of this call is also on the dollar itself. Currently, the market is already priced for a very dovish Fed. The weather, however, in the US is beginning to thaw, and our economists do expect that the start of the second quarter will bring improved economic data. We're also seeing that all of the traditional weather vanes of activity in China are currently very weak, which traditionally doesn't bode well for emerging market currencies against the dollar. So on a 3 month view, we expect that these issues, that is Russia's economic fundamentals as well as potentially high US interest rates and continued slowdown in China, these should all act to keep the ruble on a downward trajectory, even if it's only a modestly weaker trajectory over the next 3 months.
Manik, thank you very much. Well, viewers, do stay tuned as we have plenty more interviews heading your way.